This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. A friend of mine posted recently about robot traders. It was an article from a guy at CNBC that I've talked about on my podcast before. The article was titled, "Hedge Fund Robots Crushed Human Rivals in 2014. This came out in January of 2015. And my friend was not very familiar with trend following, but he knew that I wrote about trend following, recognized the name, posted the article, and his first gut instinct, and he's a smart guy, he's a programmer, his first gut instinct was to think that this was about machine learning. That these robots, the way the CNBC article positioned trend following traders, these robots from 2014, it was like, Big Blue or Deep Blue, whatever it was that beat Garry Kasparov in chess. There was some machine learning, something so complicated. And that was where the article wanted you to take. And that was where the article wanted the reader to go. That what you're going to hear about is so sophisticated, so complicated, that you, the average person out there, can't possibly understand any of this. So I went back and forth with my friend in a chat forum, and I said, hey, hold on. This is not machine learning. This is just automation. You could do this automation with a spreadsheet if you wanted to. You could code it yourself. You could buy TradeStation. Many, many ways that you could just take rules. Think about all the if-then possibilities in advance and write your rules down. And if you can write those rules down, and those rules can be coded, and the variable is easy to understand, like price data from the markets, like a daily closing price, really simple, one number per day, you can make models off that. And those models can be executed in Excel spreadsheets. That sure as hell is not machine learning. Now, of course, the people that are inventing the models, those trend following models, very bright people, work hard, smart, of course, absolutely. But the computer part is the afterthought. The computer part is just the way to automate things. And it's amazing, after all these years, I still see that the media doesn't get this. But I really don't think they don't get it. If your media conglomerate is based off giving tips and predictions and fundamental news and information all day long, 24/7, well, automated trend following strategies are not that sexy. There's not that much to talk about, even if they're damn successful. My friend got it. Kind of talked about it a little bit. He got it. A second friend, a completely different point in time. I was explaining trend following. And his immediate reaction was, and he's a smart guy too, worth over $1 million. His immediate reaction was, well, those are only rich guys. Meaning some of the people in my books and on my podcast manage multi-billion-dollar funds. So whatever they're doing is so complicated and so sophisticated that only the rich guys can do it. Now, that is a personal problem that one would immediately draw that conclusion. A personal problem can be one of confidence. It can be one of ignorance. The confidence one is harder to solve. The ignorance one is easier to solve. And if you are ignorant as to why multi-billion-dollar fund managers in the trend following space could be useful to you and your understanding of trend following, let me tell you why. I think back to how I started to get under the skin of this subject. I would look at performance data, all the way back to the turtle performance data in the early 1980s. Guess what? These weren't multi-billion-dollar funds. No. If you want to find the data to be inspired about trend following trading, it's there. It's easily found, that performance data. Of all different types of sizes of accounts, from multi-billion to far, far less. So those two issues were really my inspiration to put this particular podcast together. And this particular podcast is kind of my combination, my aggregation I've noticed that there's some really cool clips on YouTube and frankly, just floating around the web. So what I did was I went through many different types of interviews from many traders and many wise people in the trading field. And I've kind of combined them together with some of my commentary because I think all of these comments that are going to follow, these excerpts that are going to follow, get back to my original 2 points that I had a problem with, which was the notion of machine learning, trend following. This can't possibly be for you because you're not a machine learner. You're just a regular Joe. And number 2, the notion that this is only for the multi-billion-dollar funds. Let me start with the foundation. Last year, Eugene Fama and Robert Shiller split the Nobel Prize. One receiving the Nobel Prize for essentially an efficient markets hypothesis view. The other for more of the behavioral finance view. Eugene Fama getting the prize for the efficient market hypothesis. Essentially, the word bubble can't exist within that realm. It's not there. There's no explanation for the dot-com bubble within the efficient market hypothesis. Now, I'm not taking anything away from Eugene Fama. I'm sure he's an absolutely brilliant man, but wrong. Now, there have been some very, very smart academics in the last 40 or 50 years who got this right. They saw the problems with the efficient market hypothesis. They saw the problem of every university finance and econ system adopting these views. The main man, no longer with us, deceased by a few years, but I caught this audio excerpt from Benoit Mandelbrot. Absolutely fantastic insights about the efficient market hypothesis and why, when he put this out there, it wasn't accepted.
Now, as I understand it, the Bachelier theory implies that returns follow what we all commonly know as the bell curve, that most things will be clustered in the middle and there'll be just a few wider movements at either end of the scale. What did your research tell you once you started taking a look at this, which is what, in the early 1960s, I believe?
That the tails in question, which are so completely impossible to draw because they're so thin, just a few events, the tails are extremely long. And that a record one looks at can seem to be just small steps up and down, and then one gigantic step. And the gigantic step itself is very often, in a certain sense, segregated. Market stops trading. Trading stops and then it resumes at a different value. The question arises, do you take this big, enormous jump as part of the process, or do you say it's an act of God, depending upon different rules? If you say it's an act of God, it fits in Bachelier if you wish, because you have put all the big events under the carpet. And my work was very soon criticized, quite sharply, of course. And but the main critic, who wrote a very nicely written story, says that, well, we have known that there were these big values, but since we didn't know what to do with them, we just swept them under the carpet.
So if you're trying to model risk management, and that's the main use that efficient market theory has been put to, is managing risk, they're admitting from the start that they're not trying to take account of the biggest risks when managing risk.
Well, that person did state it very clearly in a critique of my work in a book that he edited in 1963 or 64.
And why do you think that the theory became so popular? Is it because it made investing look easier than it was, that it made the world look simpler than it was, or what lies behind it?
Certainly the word simpler than it was. The reference to Bachelier in terms of influence was not there. I mean, the work would have occurred anyhow. But the theory of Bachelier had become very important as the Brownian motion. And there were books and books and books about it. Many people knew about it. Therefore, there was a certain capital of knowledge, capital of wisdom, which was available and one could draw upon. And on one hand. On the other hand, my work had 1-2 references, very obscure, not very close to what we're looking at. In a certain sense, my work promised, well, great amount of work and trouble and effort. And the other promised a capital on which one could live for a while.
So in some sense this is down to academic politics, that if efficient markets were true, then we can build a lot of theories from it, and if your theory is true, then we have to work a very long time and we may not find anything that we can use at the end of the work.
Well, it's an extreme version of what I think happened, yes.
I love that Benoit basically says the reason his ideas weren't adopted was for academic infighting in politics. And there you go. Modern finance set atop infighting in politics between tenured professors at major universities. Thank you, sir. Can I have another? Fantastic, right? Well, that's the foundation. So some of these guys out there have known about efficient markets not really being the way to go for a long time. Long time. How does this make its way into the trading world? One of the most successful traders out there is a guy named Jim Simons, Renaissance Technologies. He's made an absolute fortune. He's a quant. And in this excerpt I'm going to play, he talks about being a new trader. He talks about trading soybeans, the fundamentals of soybeans, the lessons learned, and the foundational motivation for going the direction of trading.
I had just gotten married, and I had $5,000 and from wedding gifts. So my wife and I, we decided that we'd invest it. So we didn't know anything about investing. So I went to Merrill Lynch, and I asked her. I had a couple of stocks that I thought might be good, and they said yes, those would be fine. So I bought these stocks, and they weren't good. And they weren't bad either. They just didn't do anything. So after a couple of months, I went back and said, I need a little more activity here. These stocks, nothing's happening. He said, you should try soybeans. And I literally thought that was something you ate. I didn't know. But, you could trade these things. But he explained to me, yes, you can buy 5,000 bushels of soybeans for a mere pittance. You put it down and the beans are going to go up or down, or you could buy 10,000 bushels if you're particularly aggressive. That was 2 contracts. And he explained why the wisdom of Merrill Lynch was what soybeans were going up big time, and you'd make a fortune by being long soybeans. I bought it. And I bought 2 contracts of soybeans. And indeed, within the next couple of days, they did shoot up, and I was quite ahead. And there was leverage in it, and so on. And I went, and I was talking to a mathematician a few years older than me, who was a postdoc at Berkeley, and I told him what happened, and I said, do you have any advice? He said, yes. I said, what's that? He says, sell it immediately. And that was great advice, which I didn't take. And of course, it then went down, and I lost some money. And I found myself getting up early in the morning and going back and forth across the Bay Bridge to catch the opening of the Chicago soybean exchange. And they opened at 10:30 in Chicago, which was 8:30 here, which was, you know, the crack of dawn for a graduate. So who's going to get up that? I mean, I had to get up at 7:30 in the morning to schlep across the Bay Bridge and check and see this screen. And it turned out, I did this for a couple of weeks, and I actually ended up ahead. But I came to the following conclusion. I was either going to write a thesis in mathematics or trade soybeans, because it was impossible to do both at the same time. So I gave that up. But always in the back of my mind, I liked this trading business and found it interesting. And so I got back into it.
I want to add one more excerpt from Jim Simons. He talks about his path going from math to finance, modeling and not modeling, the idea of luck, and he rips fundamental trading to shreds.
In 1976, I was 38. I felt I'd been a mathematician all my life, but really sort of since I was 18, I think I was. So I guess I spent 20 years in that game and decided to go into business. And never occurring that I would apply mathematics to the business. I did subsequently, but I just felt, you know, you read the newspapers, you think you'll do pretty well. And we did okay. But after a little bit, I started collecting some data, and I figured there's something to be modeled here. There's something to be modeled here like we used to do in the old IDA days. So I brought in the best modeler in the world, Lenny, a guy named Lenny Baum from IDA, and persuaded him to come, and we're going to make these models and do great. And Lenny started making models with me, and we were fooling around. But I kept trading, and Lenny seemed to get less and less interested in models and more interested in reading the news reel. In those days, it was just a roll. It would tick away, and you'd read the news. And Lenny was always reading the news instead of thinking about models. And then he started having opinions on what was going to go up and what was going to go down. This was all foreign currencies, bonds, that kind of stuff. And I started listening to him, and he was right. He was right. He was right enough times. I said, okay, the hell with the modeling. Let's just let's just try to make some money. And we had a remarkable run. In the 2 years since I said the hell with the modeling, we multiplied our investors' money by 12. Now, that was even after their fees. That sounds pretty good, right? We were incredibly lucky. See, the last word up there is luck. Luck. Good luck. Good luck. And we certainly had good luck. Had a lot of good luck in my career. So, but in the back of my mind was, well, okay, Lenny doesn't want to build models, but maybe we could build someone else could come in and build models. And another fellow, Jim Axe, who was quite a famous mathematician, left Stony Brook to come, and he did build some models. So those next years was a combination of fundamental trading. I did venture capital. I invested in all kinds of things. But the models kept being built and working better and better. And finally, at the end of about a 10-year run, it was clear to me that this gut-wrenching business of fundamental, I mean, you know, if you're doing fundamental trading, one morning you come in, you feel like a genius. You know, your positions are all your way, and you think, God, I'm really smart. And look at all the money I made overnight. Then the next day you come in and they've gone against you, and you feel like an idiot. We were pretty good at it, but it just didn't seem to be a way to live your life, you know. So building models, go with the model. So by 1988, I decided it's going to be 100% models. And it has been ever since in the business that we built. So some firms, you know, investing firms say, oh, they have models. And what they typically mean is, you know, we have a model and it advises the trader what to do, and if he likes the advice, he'll take it, and if he doesn't like the advice, he won't take it. Well, you can't, that's not science. You can't simulate how you would do. How were you feeling when you got out of bed, you know, 13 years ago when you're looking at historical simulations? Did you like what the model said, or didn't you like what the model said? It's a hard thing to back test. So if you're going to trade using models, you just slavishly use the models. You do whatever the hell it says, no matter how smart or dumb you might think it is at that moment. And that turned out to be a wonderful decision. So we built a business 100% based on building computer models, starting in those areas that I mentioned, currencies, financial instruments, gradually moving to stocks, and finally to anything that moved. Well, it had to be tradable, it had to be liquid. Was always liquid. And you know, bringing in data. In those days, we sent gals down to the New York Federal Reserve to copy histories of interest rate numbers. I mean, they didn't exist in the 70s. You couldn't go and buy data, and there was certainly not online deliveries of all this stuff. So to build the original models, we needed to collect a lot of data by hand, which we did. And but gradually, you know, we got smarter, the models got better, we brought in more and more people. is said we have the best math and physics department in the world at Renaissance. I don't think that's quite true. On the other hand, it ain't bad.
Building on Jim Simons comes David Harding. I've had the good fortune to learn some from David Harding over the years, to spend a little time with him. Extremely bright guy, very successful. He perseveres. He is a fighter. Now, people might look at him now and say he's king of the mountain, but I appreciate that he has come from humble beginnings, and I appreciate that he has kicked butt along the way and risen. That in itself is a great motivational story. I also happen to know that he thinks very highly of Jim Simons. In this clip, Harding talks about his start. He also talks, like Simons, about models and the use of math. He talks about probability and betting. And he brings up trend following.
Originally, I studied physics at Cambridge University, but I left in 1982 and went to work on the floor of the London Financial Futures Exchange, which was the first financial futures exchange outside the United States. I started on the day that that exchange opened on the floor in 1982, and I've been trading futures ever since for the last 30 years. From the very beginning, I was very interested in the research process, in the using maths and scientific methods and computing to study data and numbers and look for forecasting methods, look for ways of forecasting the probability of different future returns occurring. We couldn't forecast prices. Nobody can forecast the future perfectly, but it is possible to make statements to a limited extent about the probability of different things happening in the future, and then to bet on the probabilities. And I, in conjunction with my partners, with whom I founded my first company, decided that there was something in this technical analysis business. So we founded a company called AHL, which went on over the next 30 years to become the largest CTA in the world, until it was eclipsed last year by Winton Capital, which I founded 15 years after starting AHL. So at that point in time, rather immodestly, I could claim to have had my name on the first and second largest CTAs in the world. And the reason that both those companies have risen to become large companies is those sorts of systems that we have used have worked. They've worked. And they've worked in the face of the overwhelming intellectual orthodoxy that it is not possible to forecast prices by using price histories. This is not an unparalleled feat, but very few methods have worked that well, and it is greatly surprising that the method that we've used, which is called diversified trend following, a basket of trend following systems trading in all of the stocks, bonds, commodities and currencies all over the world, betting on uptrends and downtrends, not just on uptrends, but by going short, betting on downtrends. And by diversifying across all those markets, I believe in the scientific method. I believe in rigorous analysis of data, in using statistical inference to make valid inferences from data using the scientific method. But my great faith going forward is that the scientific method will remain valid. And by having, as we have here, a large team of scientists who use rigorous mathematical, statistical, scientific training to analyze data and draw honest conclusions about that data, using that as the basis for our betting strategy, will be more successful than wishful thinking or making up stories, which is what so many people's investment strategies are. A very important part of the method that we use is historic simulation. We are now in an era where we can use 30 or 40 years of back data to ask what-if questions. Wouldn't want your viewers to think that I was saying that we had discovered some way of telling, which way the market was going to go, which was incontrovertible.
Building on Simons and Harding, Salem Abraham recently appeared on my podcast, was featured in my book, The Complete Turtle Trader. Salem brings fantastic insights as well. Now, he's gone from small to large to small to large. Again, he perseveres. He perseveres and sticks with it. In this excerpt, he talks about the markets he trades. And most importantly, he talks about why does it really make a difference where the money comes from?
My background growing up was really, I was good in math and statistics, probabilities, things like that. I liked game theory, and so I went off to Notre Dame, got a finance degree, and while I was there, I discovered this idea that you could make money trading in futures markets and trading technical systems. And so now the professors at Notre Dame didn't tell me that. They actually told me it wouldn't work, but I discovered it on my own, doing some research on my own on ideas, and I wanted to move back here, and if I could, and run a business from here. And so the idea of trading in the markets was something that could be done from here, and it fit my skill set. I think it's helpful just because you don't have the distractions of the city, you don't have the noise of what other people consider deal flow. We don't need the deal flow, we need data. We're data guys, we're numbers guys, we're math guys. I knew that I had enough statistical evidence that said there's something unique about this particular price action that gives me a predictive value in the markets. And then the idea is then to have lots of those that you've discovered and then make lots of little bets and then let the odds and the probabilities play out in your favor over time. It's not a game of home runs, it's a game of inches, it's a game of just taking your time and not taking big risks, and then just trusting that the statistics and the models and the probabilities will play out in your favor over time. It's interesting to see the same pattern in hogs as in the Japanese yen, as in gold, as in crude oil, as in cocoa or wheat. And you say, well, I wonder why would this same pattern exist in all these markets? But the common theme and the common thread is humans. Humans trade them all, and humans act on emotion much more often than they're willing to admit. And because people are emotional and predictably irrational, you can go see those patterns in all different markets. We trade a lot more of what we call commodity futures versus financial futures. So financial futures would be currencies, interest rates, stock index futures. Those are half of what we trade. Most CTAs will end up, that may be 70-80% of what they trade. And the smaller piece of the puzzle for other CTAs is a pretty big piece for us. It's a little over half. 51% of what we do is commodity futures. So things like wheat, corn, soybeans, cocoa, cattle, zinc, nickel, orange juice, the milk, lumber. Most people don't trade them because they don't have as much volume. And they say, we don't mess with those. Well, we've been trading them long enough, and we can deal with that low volume and can still do trades and have trading systems that really are designed for thin markets. It's the way you do it, and you design them for those thin markets. But the reason to trade those thin markets is because they still have a potential for profit. And so we're from the country. We don't mind if money's made in yen futures, which seems pretty sexy, or cocoa futures or milk futures. And so what it does for our clients is it provides them an opportunity to have exposure to some markets that are very good for helping achieve diversification for them and for us.
Continuing to build on Jim Simons, David Harding, Salem Abraham. I'd like to add Jean-Philippe Bouchot, a French physicist by training, now a fund manager, who knows quite a bit about trend-following trading. And from that deep science background, he offers insights.
What we're doing different is that we're trying to be very disciplined about the way we make investment decision. We're using statistics everywhere in what we're doing. First of all, we are using statistics because we are looking at small but systematic effects, which allows us to predict a little bit of the future knowing the past. And that's using many different types of data and different types of statistical analysis and so on. But it's also because we diversify our bets as much as we can. That is, our portfolio of stocks, for example, is 3,000 stocks wide across the whole world, planet, Australia, Japan, Korea soon, and of course Europe, UK, United States, Canada, Brazil. And so even if we have a very small probability to be right on any given bet, by making a lot of bets we hope to extract some signal out of a huge amount of noise. So that's why we're doing it. Is the signals are very small, obviously, otherwise people would exploit them. So you have to work very hard to identify these effects, and then to work very hard to not lose them in all kind of frictions, transaction costs, risks, and so on. So that's engineering close to actually watchmaking in a way, because everything has to be very, very precise. If your question is, I want to understand how the market works and what can happen, then you don't need to be predictive. You don't need to, if your ambition is to, for example, assess the risks, then what you should do is to look at all these price changes and try to reconstruct a probability distribution for price changes, and construct, like in earthquakes, probability to have an earthquake with magnitude larger than 8, 9, 10. And that you can do using the data without understanding where these earthquakes come from. So in a sense, this is extracting statistical signal from noise, which is interesting but doesn't allow you to predict. But it's in itself an important activity, and it's useful for many purposes. I mean, all the derivative markets are based on understanding what the noise is like. That is, this distribution of events has to be understood to price certain types of derivatives. But it's still, leaving all these signals as unpredictable. So that's what the common sense would call noise. But then in the middle of all this noise and impossible to predict phenomena, there's a little, very small signal, which is what is going to happen tomorrow. So in this amount of data, noisy data, if your ambition is to try to predict something, then you have to work harder than just identifying these earthquakes I was talking about and their relative probabilities. And you have to find something stronger, which, although it exists, it's still very weak. And, as a kind of rule of thumb, maybe you can predict with 51% chance of success what's going to happen, but not much more than that. So what we're trying to do is to extract this little tiny piece of signal out of a lot of noise to make something of it. And what is this something is to trade assets and provide our investors with a decent return at the end of the year, made, as I said, of very minute bets on a huge number of different instruments. So that's our job.
It's not just New York, not just London. Trend following traders are all over. Svante Bergstrom, Lynx Asset Management. He too, a trend following trader. Sweden. See, trend following, like Salem Abraham talked about, is location independent. It doesn't make a difference where you are. You think your geography is important? You've missed lesson 1. This manager, as well, a multi-billion-dollar manager, did not start that way, but lessons to be learned.
My mindset is to be very systematic and do things in a very systemized way, and that's really why I like this way of managing money with the help of models and statistics and mathematics. We really believe in trend following as a strategy, but on top of that we have put a lot of other models to get a more diversified portfolio. So I think Lynx has a broader universe of models compared to most CTAs out there. We have done this for like 15 years, and one thing that I've learned is that we can't predict what positions we will make the most money out of the coming year or so. Afterwards, you will always be surprised to see what was the trigger and what was driving the performance. And that's the really exciting stuff, being a systematic CTA, that you follow your models and you believe in your models, and at the end of the day, you know that they will deliver a performance if markets are trending.
Building on the many bright thoughts from the many very wise traders that I have excerpted so far, I'd like to introduce Ewan Kirk of Contab Capital. Ewan has also appeared on my podcast. Ewan has also done fabulously well with a primary trend following strategy. In this excerpt, he defends models. He talks about the idea of being unlucky versus broken. And he goes into the trend following logic.
Systematic models, like every other investment style, they don't work all the time. Equities don't work all the time. I'm sure we all remember 2008, where the equities markets were down 50%. That doesn't necessarily mean that investing in equities is wrong and is never going to work again. So the way we look at it is that when we have periods of flat performance, or even periods of poor performance, which sadly happen to us all, then we look at what we do from a very skeptical point of view. We're always trying to see if there's something wrong, but the fundamental thing is, if you can't see that there's anything particularly wrong, anything statistically wrong, then it's likely that what you're doing is just being unlucky rather than broken. But we can be wrong, but certainly that was the way that we looked at our models, and I think it was the way that our peers in the industry also looked at the models, was that they were just going through a period of bad luck rather than necessarily a period of being, or rather I should say, being broken forever. There is an element to the returns of all securities, where if they're going up, they tend to continue to go up, and if they're going down, they tend to continue going down. That's the very traditional trend following or momentum trading. Now, it is right to chase those trends for a certain period of time. And of course, what worked well for us, and worked well for almost every other systematic trader, was that over the last 6 months of the year, oil dropped by 50%, interest rates continued to go down, bonds continued to go up, the dollar strengthened dramatically. And our models said, well, the dollar's been going up for a long time, it's probably going to keep going up, and indeed it did. And that's what models do. So it's not necessarily return chasing in the sense of investing in hot managers, which may not and probably doesn't work. It's much more about following trends, and I think probably the heart of it is following trends or following rules in a very disciplined way. If there's one thing that systematic traders are very good at, it is the discipline of investing.
Now, except for Benoit Mandelbrot, who is no longer with us, I've been quoting from very experienced trading pros who are very active today in 2015. Now I'd like to play two clips from two what I would call trend-following legends. First, Bill Eckhart, who still trades, who still runs a fund. But this fabulous clip from, I think it's from 1990, I could be wrong, which would put it about 25 years old. And Bill talks about people that don't reduce their trading size during a drawdown and trading based on past equity. Two real big no-nos when it comes to trend following. The overall speech was about memory, less trading, just a fabulous piece. And many people probably have not heard Bill Eckhart talk. Great insights.
A few foolhardy traders use the following strategy. They don't reduce their trading size at all during drawdowns, since, of course, such reductions greatly increase the amount of time it takes to recover from a drawdown. What they do is they trust that their system is well enough optimized so that they'll never have a 100% drawdown, which is the only thing that ends the game under this sort of procedure. Okay, now at first glance, it might seem that such a trader is trading in a memoryless fashion because, and I'm only half joking about this, it's sort of as though he doesn't have the memory, he's forgotten to adjust his unit size. But actually, this kind of trading is a big violation of present-oriented trading. It's a violation of the worst kind. Because what a person is doing who is not adjusting his trading size to current equity, what he's doing is he's trading based on past equity again. And past equity is strictly irrelevant to your trading. I mean, literally, the stork population in Stockholm is as relevant as your past equity to the question of what's the optimal course now. Okay, let's look at the classic trading mistake. This is letting losses grow and grow and grow out beyond all reason. I mean, we all know this is wrong. Well, exactly why is it wrong? The present-oriented trader can immediately detect two errors in this procedure. First, the trader's trying to recoup. This is what we talked about before with Bernard Baruch, and that's wrong because recouping by definition is defined in terms of the past. And not the past of the world or the past of the market, but your own personal past. And it's the wrong thing to look at in trading. But there's a second thing wrong here. He's not only trying to recoup, but he's trying to make the money back in the same market and on the same position. It's a kind of a market vendetta. This market's hurt him, and now he not only wants the money back, but he wants it back the same way he lost it. That's why he's letting this loss grow. It's, as I said, it's a market vendetta. It's a personal memory. This is one of the many ways that personal memory can lead to disaster.
I feel fortunate to have that speech by Bill Eckhart in my possession. Just absolutely fabulous. Going out, I would like to conclude with Ed Seykota. You may have heard this, you may not have heard this. Either way, it's great. He takes trend following and reduces it to something we can all understand. Before I play the clip, one quick piece of insight about Ed Seykota, and I think I've said this before. When I first met him, we sat down. We were somewhere in the islands, I believe. And like I said, it was my first meeting. I did not know what to expect. But I kind of had the feeling that I was dealing with someone of a different intellect. Very wise. You could just tell immediately. And he knew that I had a website called turtletrader.com. And so he asked me, what did you think Richard Dennis was looking for when he picked his students? I just said very calmly, I thought Dennis was looking for people that could think in terms of odds, mathematical odds. And Seykota looked at me and he said, did someone tell you to say that? It was an interesting introduction to say the least, but we did become friends and we've shared a lot over the years. This musical clip from Ed is great.
Hi, I'm Ed Seykota. In response to numerous requests over the years to reveal the inner workings of my trend trading system, I hereby take great pleasure in presenting its essential elements for your financial edification. Joining me today are several members from the Northern Nevada Bluegrass Association. We gather to play benefits for local area hospitals. If you are currently in a clinic as a recovering marketaholic, or even if you have a mild case of marketitis, this tune might put you on the road to recovery. In any event, pull up a chair, lean into your monitor, and lend us an ear. We hope that you enjoy the show. You get a whipping, I get a saw, honey. You get a whipping, I get a saw, baby. You get a whipping, I get a saw. One good trend pays for them all, honey trader, baby mine. Now what do we do when we catch a trend, honey? What do we do when we catch a trend, baby? Well, what do we do when we catch a trend? We ride that trend right to the end, honey trader, baby mine. So you get a whipping, I get a saw, honey. You get a whipping, I get a saw, baby. You get a whipping, I get a saw. One good trend pays for them all, honey trader, baby mine.
Well, what do we do when we show a loss, honey? What do we do when we show a loss, baby? What do we do when we show a loss? We give that daggone loss a toss, honey, baby mine.
Well, you get a whipping, I'll get a saw, honey. You get a whipping, I'll get a saw, baby. You get a whipping, I'll get a saw. One good trend pays for them all, honey trader, baby mine.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.